Hello, this is Brian Resney, President of Resney Wealth Management. I'm bringing an important update about the economy and the investment market so you can better understand at Resney Wealth Management what we're currently invested in and also what we currently see. Before we talk about the economy, I wanted to go over a few bullet points and really stress to investors who are not clients the difference Resney Wealth Management offers. Number one, we run an active investment strategy that is adaptive to changing conditions in the economy and all the investment markets. The number one reason investors fail with their portfolio is first, who they entrust with their money. The sad fact is most investment professionals are really just acting as brokers and don't actually manage your money. So if you've ever bought an annuity, mutual funds through a brokerage firm or insurance company, I can pretty much rest assure you your money is not being managed. If you're not under a registered investment advisory agreement, then you have what's called a brokerage account. Under a brokerage account, your broker, which may use a fancy title to mislead you, does not manage your portfolio. In fact, their firm's objectives are substantially different than yours. Substantial conflicts of interest are there when you have a brokerage account. So what I always tell investors is number one, whom you entrust your money to is important. If you work with any insurance company, broker, you've ever bought an annuity or mutual fund, or you don't know the difference between brokerage account or advisory account, I can pretty much guarantee you probably have a brokerage account, meaning your money's not being managed. Number two biggest risk to you, the investor, is emotions. Because you have probably a brokerage account, your money's never been managed before, so investors tend to make emotional decisions when their money starts falling apart, like in the recession of 2008 and again in 2000. At the end of the day, emotions are going to hurt your portfolio. Number three, again, if you use a broker or brokerage from an insurance company, you probably have, again, a brokerage account. That means you don't have an investment strategy and nobody's following it. So again, this often leads to mediocre returns and substantial risk in a portfolio. I see this every single day and every single month in our offices and the calls I receive on my radio and TV show. At the end of the day, you need to understand whom you entrust with your money. If you do not have an advisory account, if you are not under a registered investment advisor agreement, if you're not working with a fee-only registered investment advisor like Resney Wealth Management, the rest is sales. So at the end of the day, risk management is important and investment strategy is important. Now I'm going to talk a little bit about this economy and the market. We continue to see the market in the U.S. primarily good. We continue to be heavily weighted in U.S.-based equity, small, mid-cap, and large in the U.S., and we pretty much shun almost every other sector around the world because most other sectors, specifically large cap emerging market and developed countries, are actually relatively weaker. In fact, when I looked at rankings this morning alone, most large cap emerging market economies are actually flat to negative for the year. Flat to negative. So again, if you're just doing a buy and hold asset allocation, or the pie that I call it, this is going to be a recipe for disaster. Also, in the next recession, when we do eventually have one, which I guarantee all of our radio and TV listeners we will, if your portfolio strategy is not adaptive, meaning it's able to change direction, it's able to get conservative when you need to be conservative, it's designed to be more growth when it needs to be more growth. The key word you need to remember as an investor is your strategy cannot be one-sided or lopsided or set it and forget it. It has and it must be adaptive to changing market conditions. If your portfolio is not adaptive to changing market conditions, you're either going to hold equities or equity-based mutual funds on the way up, and you're going to ride them all the way back down again, like in 2000 and in 2008. Remember, statistically, equity markets drop 30 to 50+% in recessionary environments. If we're headed for another recession one day, can you afford another 50% drop like the last two that most investors experienced in the last two recessions? Probably not. The key to an adaptive portfolio is simple. As changing conditions happen not only in the economy but the world and any investment market, your portfolio should be able to freely be in relatively stronger asset categories. Sometimes that means going to cash. Sometimes that means being a little bit more growth oriented. At the end of the day, conservative investors year to date are probably making almost zero return on their money. So ultimately, the biggest risk you have as an investor is not running an investment strategy that's adaptive and can change and improve your portfolio to changing market conditions. I hope this update video was of interest to you, and I hope you learned something from it. More importantly, if you're not a client, maybe it's time you became a client. Call my firm for a consultation. We could sit down with you. There's no cost for that no cost or obligation for the consultation. Why not sit down with us, get a second opinion over your portfolio? Let's find out what's really going on. If you really seriously care about your money, you want to avoid running out of money during retirement, and more importantly, you want to grow and protect your portfolio in any market condition, call my firm for a consultation. There is a substantial difference on how we manage portfolios. Find out how that is and how it can benefit you and the safety of your retirement. Have yourself a safe